What's going on, guys? It's your boy Rigo checking in again for another video. This is going to be video number 4 of 30. We're doing the 30 by 30 videos, 30 weeks. Every Wednesday you guys are going to be getting some good content, some good value, something in regards to the real estate, different loan programs, different expectations of escrow processes and things of that nature. So if you guys want to continue to follow below, subscribe, like, share, comment. Love everything about this video, guys. Thank you guys for supporting. I love you guys. The team loves you guys. Luxury Premier Group with Ambiance Realty again, guys. Thank you very much for all the love and support. Just want to give you guys that heads up before we dive in. All right, let's go. So really quick, guys, Calhfa. I think I probably talk to 3 to 4 people on a daily basis that tell me, hey, what is the first time home buyer program? What kind of stuff do I get? I heard something about no money down. I hear about the government programs or something along those lines. And this is it, guys. So strap in real quick. If your family wants to see this, strap into this, because I want to say everyone and their mother has already heard about this program. Again, Calhfa. The Calhfa program is quite simple. We're going to go through the pros. We're going to go through the cons. In my honest opinion, I'm going to be a little biased. I'm being fully transparent with you guys. I don't personally like this program. I do like it if you don't have the excessive money to do it, or if you want to leverage your money, so to speak, right? If you want to leverage the down payment and you want to put it elsewhere, or vice versa. A lot of times this program is used for first-time home buyers that want to save some cash, but in my honest opinion, I don't personally go with it as the first option. Cool? And the reason why is, I'm going to go with the pros first, actually. We'll go back to the cons. As you guys can see, there's a lot over there and there's not much over here with the pros. Matter of fact, even taking it a step back, going into the documents that are required. So documents that are required, everything that you normally typically see on an average pre-qualification, the tax returns, the pay stubs, the bank statements, the ID, the social, depending on other income sources that you have, you would input that, but this is the basic stuff. One difference that you would have on this than any other loan is that you need an extra year of taxes. So instead of needing 2, you need 3 consecutive years in order for you to qualify for this loan program in particular. So that's one of the major differences. All the others, very straightforward. 30-day pay stubs, bank statements for the last 2 years, just showing proof of funds, ID, social. You do have to be a citizen in order to qualify for this program. So you do need a social and all that other good jazz. No DACA or anything like that. Social is what you need. American citizen, typically. All right. So again, pros, no money down. Quite simple. You guys all know this. You can come in with different programs. Breaking this down a little further, this no money down, you can either come in, typically I like to say 1%. 1% of the price of the home is what you would come in with for your closing costs. So if, giving you an example, if your house is worth 400K, 1% of that is $4,000, and the rest will be covered by Calhfa, right? They give you a certain amount of points, which is why I tell you guys typically 1%. Again, if there's a range, it's a various range that you would go through depending on your qualifications and your standards and what's available. But normally you want to go 1 to 2%. Of course, if you could put more money down, it's a cheaper rate. So that's kind of how it breaks down. If you go completely zero, you're typically getting a higher rate, a much higher rate than if you would maybe come in with 1% or maybe 2% of your own cash. Make sense? So again, as you go down and you have more money coming in, better pricing. Higher rate when you have zero money, lower rate when you have a little bit more money invested, just because it's a little bit more skin in the game. You're not borrowing a ton more money on top of what the loan is. Okay. Second thing, and this I honestly added it in there. Again, I'm being a little biased, guys. It's a first-time buyer program. That's one of the pros. When you're a first-time buyer, you can benefit from this. When you've already purchased a home, can't do it anymore. Okay? That's the other thing. There may be other pros, but this is typically what you look at for something like this. Is the biggest one is just you coming with no money. $4,000 to $8,000 normal is average. What I've found with previous clients, sometimes they'll come in with $3,000 to $5,000 depending on the price, but right here in LA County, you're looking at 4 to 8. Okay? Orange County, LA County, 4 to 8. I had a client come in with about, I want to say a client by the name of Ramon. They came in with about 3,000, give or take, about 3. And they were in Riverside. Came in with about 3,000. And they actually had a great opportunity there. But here's where we dive into the cons. And this is why I don't typically recommend it unless you have no money, because a lot more cons in my opinion, guys. So the first thing is lower pre-qual amount. So what I mean by lower pre-qual amount is, let's just say with an FHA loan, if you haven't seen that, go check that video out. But an FHA loan, let's say you're qualified for 450,000, right? Normal, 450. An FHA loan will normally qualify you at a higher amount because one, you're coming in with more money down and you have a higher DTI ratio. With the Calhfa, you qualify for less because you have a lower DTI. I want to say FHA is 46 or 45.99 front end, 56.99 back end. Calhfa is just a 43, I believe. 43 front end, 43 back end. What that means is your income minus your debt equals your ratio. And you cannot go over that number. What that means is the same ratio that you have qualified for Calhfa will qualify you less than with FHA. You're also coming in with more money down. So more money down equals more qualification. With this one, less money down, less qualification. All right. So that's another thing. We kind of did a 2-for-1 special there. Lower pre-qual amount, lower DTIs. The second one is a higher interest rate. Like I explained to you guys in this section here, less down, 0 down, you're coming up with a higher interest rate. Don't quote me on these interest rates. I just will give you what I've seen the past couple of, not months, but weeks. Anywhere from 3 to 3.5% is what the California rates, Calhfa rates have given us. If you Google it, California or Calhfa rates, it'll give you kind of a breakdown of the different conventional FHA options and how much is being financed on the ZIP. ZIP being if you're going to get 1% for closing or 2% or 3% or nothing. All right. Again, don't quote me on that. Google it. Do your research on your own. But that's typically what it is as of right now. Going into the next one. This is probably the biggest one, guys. And this is why I don't like it, or I don't particularly recommend this program. Because yes, there are other programs out there that it's granted money, where the money is given and you don't have to pay it back after a certain amount of time of living there. This particular program, Calhfa, does not do that. What I mean by that is down payment that is not gifted to you, but borrowed from the Calhfa. Then you have your closing costs. That is typically borrowed, right? So your down payment is 3.5%. Boom. That's borrowed. Then you have your closing cost, 1 to 2%, borrowed. I'll put some figures on there for you if you guys would like. Let me just bust out this calculator real quick. See if I can free some space up. Maybe I'll free some space up down here. Right here. So I can write it for you guys. You guys can see this a little more copy. You just kind of have a better idea of you visual learners. So let's just, using it for good numbers right now, good faith numbers. Let's just go 400,000. The house you're buying right now is $400,000. Calhfa gives you 3.5% for your down payment, right? So going 3.5% of 400,000, 3.5%, 14 grand. So that down payment, you're gonna get your first loan, and you're gonna have your down, and you're gonna have your closing costs. Boom. Your down is 14K, right? Boom. Down, first one, 14K. Closing costs, let's just go on the higher end. Matter of fact, I'll give you guys the lower end, 1%. Let's go 4K, right? And keep in mind, again, this money is borrowed. It's given through the government. And the way that they do it, as I'll explain to you here shortly, is you got your down, you got your closing costs, and you got your loan. So your loan is typically found based on whatever the loan is minus whatever the down payment is. In this case, you're kind of upside down, because you're borrowing more money than what you're putting down. So you'll have your first loan. I'll just give you guys just a solid number right now. Let's just go with 400K. So you have your first loan. This is what you're paying on every month. Your average monthly payment, this is what a normal house loan is. It's your first loan. If you look at your property details, you'll have a first lien. And in this case, you'll either have a second or a third lien sometimes if you borrow too much money. And you might ask yourself, okay, what does that matter? Like, how does that affect me? What does that, I'm getting money borrowed. I'm getting into a house with $4,000. Yes, you are. But this money is not gifted. You got to pay it back. So if you ever sell this home or refi, you have to pay that back, right? So you have your 400K, and then you have this other money that you borrowed as well. It's 28 grand. And to top it off, I didn't even put in the cons, there's an interest to that money borrowed. So over time, it accumulates money, and as the months go by, if you don't continue to pay that, it's gonna grow, right? So let's just say you go for a year's worth of time, you're not paying this 28 turns into 31. Now you have $31,000 that you owe on top of your loan. If your house for some reason drops value, you purchased at 400, you're really in debt for 431, and your house is only worth 400, what you purchased, you're $31,000 negative by borrowing this money. This is why I don't like particularly this program. Again, it's not bad or it's not wrong to do it. It's just a way of getting into a property that I wouldn't suggest first option, okay? And again, if you, let's just say 5 years go by and you're at 500K, the house is worth 500, but that same 31,000 maybe accumulated in 5 years, 10 grand. Now you're at 41, but you paid your loan down a little bit. Maybe you owe 417. Then you're okay. But again, you got to remember that the money that is borrowed has to be paid back with interest. So the down payment would be paid back, closing costs would be paid back, and then of course your first loan. You don't pay all three. You're only paying, and the loan that's given to you is only on the first lien. The other ones you can pay as you please. They don't have a specific payment. They don't have a monthly that has to be given. You just have the accumulated interest that you have to consider, and you just have to make sure that you're keeping an eye on that, because if you ever sell and you're in the negative, you won't be able to sell. You'll have to pay the difference, or refinance, you'll have to pay the difference. Cool? So that is honestly the number one reason why I don't recommend it, because you have 3 loans on one house. You're going into negative purchasing a big purchase to begin with. So I usually go with FHA or something that's a little bit more money down. You have a lower payment, but you don't have these 3 loans. You just have one. Perfect. And yeah, I just added this in again because again, it's a last resort. It's just something that doesn't happen. And I missed one actually, but it's just something that doesn't typically support you. You're not, as a real estate agent, I'm not a financial advisor. I'm not a lender, but I'm still here to support you guys as the buyer or a seller in this case, maybe buying another home. I'm here to advise you in a way that if I would be in your position, I would do the same thing. This is what I would do. I would put you in a place to where I want you to win, because if roles were flipped, I would want you to do the same to me. I would want you to be by my side and guide me and make sure that I can trust you and you be transparent with giving me the right information. Okay? And yeah, again, it's not a bad program. If it falls into place for you, do it, because purchasing a home is better than renting, in my opinion. Again, some business owners will go against that and say lease and rent and all that other good jazz. But my parents purchased their house in 1 year, in a year and a half, almost 2 years. They dropped their payment almost $1,000. Now they're paying exactly what they were paying for rent, and they also have $100,000 in equity in the bank. So, I mean, to each his own, right? So coming back to this last one, guys, real quick. In this current market, a lot of these videos that we're filming right now are in May of 2021. So the year 2021 is very interesting for real estate, because real estate right now is booming. The prices are very high, definitely a seller's market. Really good for buyers on the lower interest rate side of things. But right now, no one, in my honest opinion, that I've seen or that I've heard, even lenders have told me like, hey bro, just don't recommend this program. They're not getting accepted. And it's the truth. A lot of the programs, everyone is coming in with some sort of down payment. So if your loan program doesn't have with some kind of money that you're coming in with personally, you're likely not going to find anything anytime soon. You're going to have some time to be patient. So again, if you're looking to buy a house right now, Calhfa is out there that it's recommended, not so much at this moment because they're not being accepted. Okay? Again, if you guys have any questions, guys, I appreciate you guys sticking through these videos, a little longer videos, but great value. Comment below, like below, share, follow all your people, uncles, brothers, primos, tios, tias. If they want information on this real estate game, comment them below. Would love to connect with them and maybe get them into a house. Again, guys, love, peace, and chicken grease. Let's go.